I'm going to talk to you today about conventional yields. Bank savings rates in economies with stable currencies are about 1% per year at the moment. Unless the bank interest rate is above the inflation rate, then your capital will be eroding in value. Remember that deposits in a bank are on the bank's balance sheet. If we have another financial crisis and there is a bank holiday, then access to funds might be limited. Bail-ins would also be possible, which could lead to loss of apparently safe funds. We have not yet seen how national deposit insurance schemes operate under really stressed conditions. Buying bonds from stable governments or high-quality companies will usually provide a fixed income, with the rate set when the bond was issued. At the end of the term, for example 30 years for a US Treasury bond, the face value of the bond will be repaid. It is generally possible to trade these bonds before the term is complete. If interest rates go down, the bond becomes more valuable because it is paying a relatively higher rate, and buyers will be prepared to pay a premium over the face value. If interest rates go up, buyers will only be prepared to buy at a discount, so you've got potential capital loss there. Although the face value of the bond is repaid at the end of the term, the risk for longer term bonds is that this will be worth less in real terms. Dividends are available from certain shares on the stock market. The dividend amount will depend on company profits. The percentage depends on the share price. Share prices can rise or fall significantly, not just based on the company's performance. Take IBM as an example. The dividend is about $6 per year. This equated to 3.7% in early 2018, but the share price has dropped 25% since then, so now the dividend rate is 5%. Dividends from shares can protect against inflation. Liquidity in quality shares is usually good. With rental property, the costs of maintenance, insurance, taxes, and possibly loan servicing need to be balanced against the rental income. Over time, a property will generally maintain its value in real terms. However, property isn't a very liquid investment. Let's have a quick look at K-coins. The yield will depend on velocity in the Kinesis monetary system. At a low 5% velocity, the yield would be just under 2%, whereas at the projected 30% velocity, the yield would be nearly 12%. Unlike paper money, gold and silver will maintain their value in real terms. K-coin holders have allocated title to the underlying bullion, and this is held securely outside of the banking system, but is just as liquid as a bank account. So, no counterparties, pretty solid yields, and easy to spend or transfer.